Chinese regulators are warning banks to be prepared for the bubble to burst, at least as far as housing goes. Banks have been told to conduct new stress tests. Joining us now with reaction to the news is Jing Ulrich. She is chairman of China Equities and Commodities at JPMorgan Chase. Forbes has named Jing as one of the 100 most powerful women in the world. She is with us now from our Hong Kong newsroom. Jing, thanks so much for joining us this morning. So the Chinese government suggesting stress tests to entertain this possibility of home prices, housing prices dropping by 60%. How likely a scenario is that on a scale of 1 to 10 in your view?
Well, I think for housing prices to drop 60%, something extreme has to happen. It is very unlikely for China's housing prices to plunge that much, because one thing that's very important to keep in mind is that the loan-to-value ratio in the Chinese banking sector and the property sector is very low. For example, if you look at the entire market, loan-to-value ratio is about 50%. In other words, consumers put down a lot of down payment when they purchase homes. So that really is an important cushion for the banking sector.
Yet, to a certain extent, I mean, the government is obviously concerned about a potential housing bubble. I mean, they have banned third mortgages. They are making people put more and more money down for even second mortgages. So it seems like the government has a watchful eye. Do you make anything of this idea that 60% could be the worst case scenario? Does that say something about what's going on in the property market in China?
Well, you know, the banking regulator in China has been extremely prudent in the last several years. They've done a series of measures to try and curtail speculation and also try to contain risk in the banking sector. So I think the 60% drop in the property market would be really the worst case scenario. Earlier on, Chinese banks were asked to conduct a stress test based on a 30% drop in property prices. And the results actually came back quite encouraging. Basically, most of the banks said that if property prices drop 30%, NPL ratios will go up by only 0.5 to 1.5%.
But Jing, I think that's why people are reacting, because it's double. As you mentioned, it was 30%. Now we're being told to look for a possibility of 60%.
Well, you know, I think the market is reacting today on the back of this news. But let's look back to fourth quarter of 2008, when the property prices dropped probably 30% during that one quarter. The Chinese banks' asset quality was barely affected. So again, I go back to my point about loan-to-value ratio being very low in China. Consumers' balance sheets are not very stretched. The leverage ratio in the banking sector, in the consumer sector, is actually relatively low. So therefore, I think the banking sector can withstand a normal correction in the property market.
So obviously, you don't think that even if this worst-case scenario happened, that it would hurt Chinese banks?
Well, if the worst-case scenario happened, the non-performing loans ratio would clearly go up. But I think at this point, the regulators are very prudent. They're warning banks not to lend to highly risky customers. They're basically raising the capital requirements across the banking sector in China. Down payment ratios for second mortgages, third mortgages have gone up. So I think we're now having enough defenses in the system to basically ensure that the Chinese banking sector's asset quality remains sound going forward.
Jing, thank you very much. Last quick question here. Housing tied to steel, cement, and aluminum. How much would those industries feel it if this scenario played out?
Well, you know, you're absolutely right. We're seeing new construction activity slowing down in the fall of this year because transaction volumes have dropped quite a lot. So I think starting the fourth quarter this year, we are going to see the impact on building materials.
Jing, we thank you so much for your time. Jing Ulrich joining us there from JPMorgan.